Thank you, Chairman. It's a pleasure to be here with you today to review the performance of your company and to outline some of the key strategies which we will employ during this year to ensure we deliver financial results which meet the expectation of all our stakeholders. My presentation today will look at the following areas. It will give a brief overview of some of the key economic indicators and market challenges we have experienced last year. We'll overview our financial performance for 2010. We'll provide some details on the performance of our subsidiaries. We'll review some of our significant milestones, have a brief look at our corporate social responsibility programs, look at our Q1 results, which were just released yesterday, and finally provide some highlights on our business plan as we move forward. So let's start with a brief economic overview. As you'll recall, in February 2010, the government of Jamaica implemented the Jamaica Debt Exchange Program, which resulted in Scotia DBG exchanging its entire stock of Jamaican dollar debt instruments for assets with a significantly lower coupon rate. Since this program last year, yields have continued to fall on government of Jamaica local debt, with real interest rates actually falling into negative territory in June this year. With the reduction in interest rates, the government's fiscal profile has improved. What has been significant has been the fall in the debt service ratio as a percentage of total revenue. This has helped to reduce the fiscal deficit as a percentage of GDP, positive signs for the economy. This renewed sense of optimism at home has also had an influence on the risk premium demanded for holding government of Jamaica foreign currency debt. This has allowed the GOJs to recently come to the market and raise funding for 8 years at below 8%. So in looking overall at the economic picture, it is improving. While GDP is still in negative territory, the rate of decline has slowed, and we expect positive growth in 2011, albeit only 0.5%. Inflation continues to run in low double digits, and this is expected given the susceptibility of our economy to weather-related events and world commodity price increases. Our NIR is at a very high level, and this has given the Bank of Jamaica the ammunition it needs to continue to reduce interest rates. Overall, it's an encouraging picture and certainly greatly improved from 1 year ago. So with this in mind, let's look quickly at some of the key market challenges which not only Jamaica, but the entire global financial system faced in 2010. Despite all the money poured into various quantitative easing exercises by the developed economies, growth outside of Asia and Latin America has remained sluggish. A number of European countries have been faced with increased fiscal deficits, which has led to bailout packages by the European Union. Commodity prices continue to rise, fueled by the growth in China and India. On the local front, unemployment remains in double digits, and with the JDX, margins have tightened on repos at the same time that the FSC has imposed new capital standards on the securities industry. As Chairman Bassiani mentioned a short while ago, the industry will have to change to meet the new realities to come. So let's look more closely now at our financial performance in 2010. For the financial year ended October 31st, 2010, your company achieved after-tax profits of $1.48 billion, which was down from the $2.12 billion recorded last year. Net interest income year over year declined by 5% to $3.75 billion, while operating expenses declined to $1.22 billion. Total assets declined to $71 billion, down from $74 billion recorded in the previous year. This decline was as a direct result of our sale of our merchant bank subsidiary, as well as our continued drive to manage down the size of our balance sheet. Total equity stood at the end of the period at a healthy $8.8 billion, up 15% from the previous year. Our financial performance was achieved against the background of tighter margins on our repo book due to falling asset yields post-JDX. This had a negative impact on our net interest income. As was mentioned last year, we have taken the strategic decision to focus on growing our off-balance sheet products, unit trusts and mutual funds, and increasing fees earned from our asset management and capital markets business lines. With the introduction of new capital standards by the FSC, we feel that preparing your company for the inevitable changes to come is the right strategic direction now. This focus on non-interest revenue allowed us to increase this revenue line by 7% year over year. Also impacting our financial results this year was the adoption of a new IFRS policy related to deferred taxation. This policy, which recognizes the tax on the net interest receivable payable, had the effect of increasing our effective tax rate to 39%. Our taxation payable for 2010 was $957 million, up $502 million from the previous year. We expect tax rates to return to normal levels this year. So let's turn now to some of our key performance indicators. Scotia DBG's funds under management now stand at an impressive $118.9 billion, which and a CAGR growth rate of 26% over the last 10 years. Our gross operating revenue for 2010 was $8.04 billion, and despite being down for 2009, still showed a 10-year CAGR at 19%. Total stockholders' equity at the end of the period was $8.84 billion, a 10-year CAGR remaining robust at 38%. Our net profit for the year was $1.49 billion, but our CAGR over the 10-year period was still healthy at 30%. We're particularly proud of the next slide, which shows the strides the company continues to make to enhance our productivity. At the end of October 2010, the efficiency ratio stood at 33%, which compares very favorably to the international benchmark of 60%. We continue to look for ways to make the company even more efficient, and during the rest of 2011, we will undertake various cost and efficiency initiatives with this goal in mind. While net interest income continues to dominate the company's revenue composition, foreign exchange and securities trading, as well as revenue from fees and commissions, provided 19% of total net revenue, an improvement over last year. We are particularly pleased with the performance of Scotia DBG Fund Managers Limited last year. This company, which manages our unit trust and mutual fund business, had a great year. Operating income increased by 74% to $160 million. Our money market fund is now by far the largest unit trust fund in the island, with assets under management of $11 billion at the end of October. At the end of January 2011, our assets under management were an impressive $13 billion. The money market fund was also ranked the #1 performing fixed income fund for the third consecutive year, an enviable track record. Our premium growth fund, which is our equity fund, also had a great year, and Brian Fraser, the general manager of Scotia DBG Fund Managers, has assured me that he plans to take top spot this year. So Brian, we're holding you to that. The new kid on the block, our US dollar Caribbean Income Fund, also had an impressive year, with assets under management at the end of the period at US $38 million. EasyOwn, our consumer finance company, also contributed profitably to the bottom line of the group, earning $5.25 million for the period. The company is represented in 16 vendor locations island-wide and booked over 800 loans during the period. In looking at our milestones for 2010 and some of our achievements, we were successful in our role as lead broker and advisor to the government of Jamaica in its divestment of the Pegasus shares of Jamaica. It is worth noting that the Office of the Contractor General has publicly stated that this is one of the most transparent divestments he has monitored. I want to thank Vicent Mitchell, our COO, for all his hard work he put into making this transaction a success. As mentioned before, our money market fund is now by far the largest fund of its kind in Jamaica. Overall, we now manage 57% of all the funds held in collective investment schemes in Jamaica, a dominant position on which to build our new business model. We continue to be ranked the #1 primary dealer for the Bank of Jamaica, and we successfully divested our merchant bank to the Bank of Nova Scotia during the period. Of course, our financial performance is not the only thing we're proud of, and our commitment to corporate social responsibility is an important part of our company's foundation. In our continuing partnership with the Trenchtown Reading Centre, we constructed a reading pavilion to provide additional space for children who use the facility daily. We also hosted our annual Christmas treat for children of the Caribbean School for the Deaf. For a Labor Day project, we renovated a section of the Jamaica National Children's Home. And in recognition of our athletes, we hosted the inaugural Golden Cleats Awards at Jamaica House, where we raised 1.5 million Jamaican for the Jamaica Amateur Athletics Association programs across the island. Yesterday, we announced our Q1 results, so I wanted to use this opportunity to share with you our performance to date compared to last quarter. Net revenue for Q1 2011 was $962 million, up 10% from Q4 2010. Most of this revenue growth was in the area of non-interest income, which increased 22% quarter over quarter. Operating expenses were $307 million for the quarter, up 10% when compared to Q4 2010. Increases in expenses were mainly related to salaries, increases for employees, which was effective November 2010. Net profit after tax for the first quarter of 2011 was $467 million, up 16% when compared to Q4 2010. Total equity now stands at $9.1 billion, and we have had what I consider a credible start to the new financial year.